Good afternoon, Peter, and thank you again for being interviewed. I think your session this morning on behavioral finance was extremely well received and was a lot of food for thought, gave a lot of food for thoughts for a lot of people. And I could see that at lunchtime. They were all asking you all kinds of questions. If I may, I've got a few questions I would like to do as a follow-up to the meeting this morning. Number one, you come from Europe, you've done a lot of work in Europe, you're now in Asia. Where do you see the differences in terms of behavioral finance between European investors and Asian investors?
I think that the biggest difference is just the recognition of the whole field of behavioral finance. So in Europe and in the US as well, there's a lot more coverage of behavioral finance, it's a lot more accepted, there are best-selling books. Richard Thaler's book on Nudge, being a huge bestseller in the US, and the Behavioural Finance Policy Unit, even that sits within Cameron's government in the UK. There's a real acceptance that behavioural finance, behavioural decision making can make a difference to people. And in Asia, that hasn't really caught on yet. The level of coverage of behavioural finance issues just isn't as strong. And therefore, when we talk about behavioural finance, it's often new to people in Asia, whereas somebody in the Europe or in the US will at least have some idea what behavioural finance is, how psychology may be affecting their decision making. So it's almost green fields out here. It's fantastic. You meet investors and you can educate and really help them out.
And they're very receptive to it.
Absolutely. I think most people, and one of the nice things about behavioural finance is it is very focused upon the client. You're trying to help them understand themselves and help them perform better as an investor. So you're not coming with grand ideas and telling them how they should think. You're helping them understand how they currently think and their current attitudes and guiding them towards strategies that are going to help them out.
Okay, thank you. In the current environment, with all this risk on, risk off, lots of volatility, investors going between fear and greed, how do you keep them on track with what has been agreed upon at the outset?
Yeah, I think it is very difficult, but I think the important thing about your question is what was agreed at the outset. You need to pre-commit to many strategies in order for them to be successful. It's a little bit like the example I gave during my talk about my willpower being eroded. And I think this is something we're seeing an awful lot in markets, particularly over the last 6 months, but even over the last 3 or 4 years, that people's willpower gets eroded by the constant cycles, these very short, 3 or 4 months where we see not really any bad news coming through, so markets start to tick higher. And then somebody says something or some policy change happens and we see a pullback. And because of this constant risk on, risk off, I think the willpower of many investors to stick to a plan is very much more eroded and very much more susceptible for them to change their plan on the basis of this short-term information. So one of the biggest things that we talk about to our clients is about committing to their strategy, understanding when they go into a trade, they should predefine what their exit is. And then stick to it. Because if you end up seeing something rise 10% and then all of a sudden greed kicks in and you want to ride the next 10%, unless your expectations or there's some new news to change that, you're only setting yourself up for a fall. And one of the things that is key to that, and we often talk to our clients about as well, is about having that investment diary set up. When they go in, write down the reasons why you're making this trade, the 3 or 4 reasons. And then if euphoria kicks in, you look back at those 3 or 4 reasons, and if they haven't changed, and you've hit your exit point, go with the exit.
Okay.
If it was something you didn't invest in, you write down your reasons why you didn't invest in it. And if you see it rise, and you go back and you look, well, those reasons still hold, then you shouldn't be investing in it now just because everybody else is riding this one. And on the converse, on the other side, if something does particularly badly, but you had a great investment case and you went in, the factors haven't really changed, you shouldn't be selling out at that point either. So it's really about understanding the logic of why you went in and sticking to that strategy.
So that would apply to the current environment where in fact a lot of people are in bonds. They've been, thanks to the rally of bonds, and if you listen to a lot of the speakers over this past couple of days, there's a case to be made for equities, especially European equities. How do you go about using behavioral finance to actually move people away from this bond mentality that they have into equities, which obviously have more risk, but also much better and more attractive prospects?
Yeah, I think as a finance industry, we've been really good at selling the investment case for why I should be in equities. Valuations being lower, long-term growth is fantastic. But that isn't enough to get people over the hurdle. the way that individuals think about risk in a behavioural sense is I'm trading off expected return and my expected risk. And I want the two to be in balance according to my level of risk that I'm willing to accept. And even though we think as finance professionals that the return potential of equities has gone up, that's unlikely to have been reflected in our clients. What our clients have typically felt is markets have been falling, so the risk expectation has gone up, but my return hasn't moved. So I now don't feel compensated for getting into equities. Some individuals, of course, felt everything got riskier, but also the return potential got up. You need, as an advisor, to think through what that logic is. What's the client thinking about? What's that psychological reasoning that they're taking in order to stop them investing? And then is that properly aligned to expectations that in reality we're seeing? And then if you can educate your client about whether risk and return really has moved in the direction that they're thinking, I think it gives you a sense of tapping into their thought process and actually helping them over that hurdle.
So in the end, there's a lot of dialogue going on between the clients and the advisors in terms of, over time, at the beginning to set the objectives and then to continue to make sure they keep on track with those objectives.
Absolutely. And the concept that I was talking about during my presentation of, I've got my long-term objectives, but I've got short-term comfort desires from day to day, from this week to next week, and I need to factor those in. Because when I see markets moving around, my short-term desire for comfort and being able to sleep tonight really becomes more important in my decision-making. And it's about controlling that, giving the emotional willpower in order to say the course that's really important for our clients.
Thank you very much, Peter. This was absolutely fascinating. Thank you.